What if I told you the Federal Reserve doesn't want to save the economy? It wants to blow it up, not by accident, not through incompetence, but by design. You feel it, don't you? Your rent's up 40%. Groceries cost double what they did 3 years ago. Your salary? Frozen. Meanwhile, Wall Street just posted record profits, and the Fed keeps telling you everything's fine. Inflation's transitory. The system's resilient. But here's the thing. They're not trying to fix this. They're managing the collapse. Between 2020 and 2022, the Federal Reserve printed $9 trillion and bought up the entire economy. Treasuries, mortgages, corporate bonds, everything. They called it quantitative easing. But that balance sheet, it's not an asset. It's a time bomb. And in 2026, the timer hits zero. The Federal Reserve is trapped. Their balance sheet is so bloated with toxic debt that the only way out is a controlled demolition, a planned financial reset that wipes out your savings, your home equity, and your job, while the people who caused it walk away richer. So before we go deeper, drop a comment. Where are you watching from? Because this story isn't just American, it's global. And if you want the unfiltered truth the financial media won't touch, hit that subscribe button. You're going to need it. Let's talk about the $9 trillion lie. To understand why the Federal Reserve needs a collapse, you need to understand how we got here. And it starts in 2008. When Lehman Brothers fell, the global financial system froze. Banks stopped lending. Credit vanished overnight. The Fed's response? They invented quantitative easing, a fancy term for creating money out of thin air and buying up trillions in government debt and mortgage-backed securities. The official story? It was an emergency measure to stabilize the economy. Temporary, controlled, necessary, except they never stopped. By 2014, the Fed's balance sheet had ballooned from $800 billion to $4.5 trillion. They promised to unwind it slowly, and in 2017, they tried. They called it quantitative tightening, letting assets roll off the books without replacing them. But in September 2019, something broke. The repo market, the overnight lending system that keeps banks liquid, suddenly seized up. Interest rates spiked from 2% to 10% in a single day. Banks couldn't borrow. The plumbing of global finance was clogged. The Fed panicked and injected $75 billion into the system within hours. Sound familiar? It should. Because that's exactly what happened in 1929, in 2000, and in 2008. Liquidity crises that exposed a system built on borrowed time. Then COVID hit. And the Fed went into hyperdrive. In March 2020, the Federal Reserve expanded its balance sheet by $3 trillion in 3 months, the fastest monetary expansion in human history. By April 2022, they'd printed $9 trillion and purchased nearly a third of all outstanding U.S. Treasuries and half of all mortgage-backed securities. They didn't just stabilize the economy, they became the economy. Sound familiar? Now here's where it gets sinister. Starting in 2022, the Fed began raising interest rates aggressively, from 0 to over 5% in 18 months. They said it was to fight inflation. But raising rates while holding $9 trillion in bonds is financial suicide. Why? Because bond prices fall when rates rise. And the Fed was holding trillions in bonds purchased at near zero rates. The result? The Federal Reserve is now sitting on over $1 trillion in unrealized losses. That's right. The Central Bank of the United States is technically insolvent. Their assets are worth less than their liabilities. If they were a commercial bank, they'd be shut down by regulators. Sound familiar? It should. Because in 2023, Silicon Valley Bank collapsed for the exact same reason. They held long-term bonds that plummeted in value when rates rose. The Fed bailed them out with an emergency lending facility, pumping $133 billion into the Bank Term Funding Program to stop a systemic run. But who bails out the Fed? Nobody. Because the Fed can't fail. Not officially. They're the lender of last resort. So instead of admitting insolvency, they're engineering something far more dangerous, a controlled collapse that resets the system and transfers the losses to you. And the mechanism? It's already in motion. Now here's where the conspiracy stops being theory and becomes receipt. In June 2022, the Federal Reserve officially began quantitative tightening, the process of shrinking their balance sheet by letting bonds mature without reinvestment. The stated goal? Reduce the balance sheet to pre-pandemic levels and tighten financial conditions to fight inflation. But there's a problem. A big one. The Fed's balance sheet can't shrink below a critical threshold without triggering a liquidity crisis. That threshold is called the reserve floor, the minimum level of bank reserves needed to keep the financial system functioning. In 2019, when reserves fell to $1.5 trillion, the repo market exploded and forced the Fed to reverse course within weeks. Today, reserves are around $3.5 trillion. The Fed is draining them at $95 billion per month through QT. At that pace, they'll hit the danger zone by mid-2026, maybe sooner. And here's the kicker. The Fed knows this. They have internal models, stress tests, liquidity projections. They know exactly when the system breaks. And they're doing it anyway. Why? Because the alternative is worse. If the Fed stops QT now and keeps rates high, inflation spirals out of control and destroys the dollar's global reserve status. If they cut rates and restart QE, they admit the entire post-2020 experiment failed and hyperinflation becomes inevitable. So they're choosing option 3, controlled demolition. The plan is elegant. Drain liquidity until something breaks. A bank, a hedge fund, a sovereign debt crisis. Then ride in as the savior with emergency powers, a new digital dollar, and a financial system redesigned to centralize control. The crash becomes the justification for the reset. And the names behind this plan? You won't believe the receipt, because it's not just the Fed. It's the Bank for International Settlements, the IMF, and a network of central banks coordinating the largest wealth transfer in history. But first, you need to understand exactly how they're doing it. Let's break down the mechanism, the exact financial engineering that makes this controlled collapse not just possible, but inevitable. The balance sheet trap. The Federal Reserve's balance sheet peaked at $8.9 trillion in April 2022. As of September 2024, it's down to $7.1 trillion, a reduction of $1.8 trillion through quantitative tightening. They're letting $60 billion in treasuries and $35 billion in mortgage-backed securities roll off every month without reinvestment. Sounds responsible, right? Except the math doesn't work. When the Fed purchased these assets between 2020 and 2022, interest rates were near zero. They paid full price for 10-year treasuries yielding 0.5% and 30-year mortgages at 2.5%. Then, in 2022, they jacked rates to 5.5% in the most aggressive tightening cycle in 40 years. The result? Every bond on their books lost value, massively. A 30-year treasury purchased at 0% is worth roughly 30% less at 5% rates. Multiply that across $4.6 trillion in treasuries and $2.3 trillion in mortgage-backed securities, and the unrealized losses exceed $1 trillion. Here's the number that should terrify you. The Federal Reserve's total capital, their equity buffer, is only $43 billion. That means their losses are 23 times larger than their capital. They are deeply, structurally insolvent. But unlike a commercial bank, the Fed doesn't mark these assets to market. They carry them at book value, hiding the losses in an accounting footnote. This is the exact fraud that destroyed Enron. But when the central bank does it, it's called policy. The liquidity drain and the repo time bomb. Now here's where it gets dangerous. As the Fed shrinks its balance sheet, it's draining liquidity from the financial system. Every dollar of QT removes a dollar of bank reserves, the cash that banks hold at the Fed to settle transactions and meet regulatory requirements. In 2019, when reserves fell to $1.5 trillion, the repo market seized. Banks couldn't borrow overnight. Interest rates spiked from 2% to 10% in hours. The Fed was forced to inject $400 billion in emergency liquidity and restart QE within weeks. The entire QT experiment collapsed. Today, reserves stand at $3.5 trillion. The Fed is draining them at $95 billion per month. At this pace, Reserves will fall below the critical $2.5 trillion threshold by Q2 2026, the exact moment when liquidity stress becomes systemic. But here's the conspiracy. The Fed knows this. In their December 2024 balance sheet report, they acknowledge the risks. They know the reserve floor. They know the breaking point. And they're walking straight into it. Why? Because they need a crisis to justify the reset. The reverse repo trap. There's another mechanism at play, the reverse repo facility. This is where money market funds and financial institutions park overnight cash with the Federal Reserve. At its peak in 2023, the reverse repo facility held $2.5 trillion, a massive pile of excess liquidity sloshing around the system. But by late 2024, it had collapsed to under $300 billion. Today, it's approaching zero. This tells you everything. When the reverse repo facility drains, it means there's no excess liquidity left in the system. Every dollar is spoken for. And when the last dollar leaves, the scramble begins. Banks will bid up overnight rates to secure funding. Hedge funds will unwind leveraged positions. Treasury markets will freeze. And the Fed will have its crisis. Sound paranoid? In September 2019, the reverse repo facility was empty. The next day, repo rates spiked to 10% and the Fed launched $400 billion in emergency lending. History doesn't repeat. It rhymes. The great wealth transfer. Now here's the dark genius of this plan. When the liquidity crisis hits in 2026, the Federal Reserve will respond with overwhelming force, just like they did in 2008 and 2020. Emergency lending facilities. Unlimited QE. Bailouts for systemically important institutions. But this time, there's a twist. The bailouts will be conditional. Banks will need to adopt central bank digital currencies. Asset purchases will prioritize climate-aligned investments. Lending will be directed toward equitable outcomes. The crisis becomes the justification for a redesigned financial system with centralized control. And who gets crushed? The middle class. Small banks, regional lenders, anyone without access to the Fed's discount window or the political connections to secure a bailout. Your savings? Eroded by inflation as the Fed prints trillions to recapitalize the system. Your home equity? Destroyed as mortgage rates spike and housing crashes. Your job? Gone as credit freezes and businesses fail. Meanwhile, the banks that caused it will be recapitalized at taxpayer expense and emerge bigger than ever. This is the parasitic finance model perfected. Privatized gains, socialized losses, and a permanent transfer of wealth from the bottom 99% to the top 1%. The international coordination. But it's not just the Federal Reserve. This is a globally coordinated reset. The Bank for International Settlements, the central bank of central banks based in Basel, Switzerland, has been wargaming this scenario for years. In their 2023 annual report, they explicitly called for balance sheet normalization and proactive crisis management frameworks. Translation: planned demolition. The IMF has been pushing special drawing rights as a global reserve currency alternative to the dollar. The European Central Bank has been piloting a digital euro. The People's Bank of China has already launched the digital yuan. When the 2026 crisis hits, these systems will be ready to deploy. And the moral hazard? Infinite. Because the central banks have proven they can print unlimited money, bail out any institution, and face zero accountability. The 2008 playbook worked. The 2020 playbook worked. Why wouldn't they run it again? Bigger, faster, and with permanent control. The countdown. So here's the timeline. The Fed continues QT through 2025. Reserves fall toward $2.5 trillion by early 2026. Liquidity stress builds, first in repo markets, then in treasuries, then in credit markets. A trigger event, a bank failure, a sovereign default, a hedge fund blowup, sparks the crisis. The Fed responds with emergency measures. Rates are slashed to zero. QE restarts at unprecedented scale. $5 trillion, $10 $10 trillion, whatever it takes. But this time, the money comes with strings. Digital dollars, climate mandates, social credit scores. And by the time the public realizes what happened, it's over. The system has been reset, power has been centralized, and the illusion of free markets is dead. So what are the stakes? Everything. This isn't just another financial crisis. It's not a recession or a correction. It's a controlled demolition of the post-World War II financial order and the installation of a centralized, digital, surveillance-based monetary system. And the speed? Exponentially faster than 2008. Back then, it took months for the crisis to spread from subprime mortgages to global credit markets. Today, with high-frequency trading, algorithmic risk management, and interconnected balance sheets, the entire system can seize in hours. The Federal Reserve has created a system so fragile, so leveraged, and so dependent on continuous liquidity injections that it can only survive through crisis and consolidation. And 2026 is the endgame. But here's the lesson they don't want you to learn. Denial is complicity. Every time you trust the Fed's forward guidance, every time you believe inflation is transitory, every time you think the system is too big to fail, you're giving them permission to do it again. The moral hazard is complete. They've learned they can crash the economy, bail out their friends, and face zero consequences. So what do? You stop playing their game. You hold real assets, gold, land, Bitcoin, anything they can't print. You build local networks and parallel economies, and you share the truth because the only defense against coordinated deception is coordinated awareness. Drop a comment. Are we wiser now, or are we walking the same path in better suits? And if this video opened your eyes, hit that subscribe button and share it with someone who still thinks the Fed has your back. Because 2026 is closer than you think. The timer's ticking, and the Federal Reserve needs a collapse.